if I were to ask people what the biggest threat to their investment portfolio is, many of them would probably reply with something like an economic recession, a financial crisis, a pandemic, something that leads to a stock market crash. However, if you are an index investor, meaning you invest in low-cost index funds, a market crash is not the biggest threat to your investments. You are. In this video, I'm going to discuss why trying to time the market is the easiest way to lose money investing in the stock market. And before we get going, guys, don't forget to like this video, subscribe to the channel, and hit the notification bell so you can get notified when I publish new videos. So what is market timing anyway? You've probably heard that term a lot, but really what does it mean? Someone who is trying to time the market basically would sell their stocks off if they believed that the stock market was about to crash. And you see this happen a lot when the stock market has risen quite quickly in value or we've reached a new all-time high. Whenever we get to those points, you hear a lot of pundits and a lot of people online talking about, oh, the next market crash is coming. The next market crash is coming. So they think, okay, if the next market crash is coming, let me sell right now while everything is high and I can lock in my gains. And then they can avoid the pain that comes with a stock market crash. And then when the market crashes and prices are low, they put that money back into the stock market and buy up at the bottom and kind of ride that wave back up as the stock market recovers. That sounds pretty great, right? It's the epitome of sell high and buy low. And on paper, it sounds amazing. But in reality, it's nearly impossible for investors to pull off market timing successfully. Let's talk about why. So number one, why is market timing so popular? Really because it plays into two investing biases that all humans essentially have. The first is loss aversion. So if you're a rational investor with a long-term investment horizon, you probably understand and should accept that the stock market is incredibly volatile, especially in the short run. So within days, weeks, months, or even a few years, the stock market can swing wildly up and down. And that can be painful. And enduring that painful volatility in the short run, really, that's the price we pay as long-term investors for the immense profits we can reap from investing in the long term. But to get those long-term profits, we have to endure the short-term pain. But here's the problem. Losing is more painful than winning. The human brain is hardwired. It's kind of like back when caveman days when our survival was dependent upon not making too risky decisions, because if we made a risky decision back in caveman days, likely chances you would get eaten by an animal or a predator. And that hardwiring has kind of continued through evolution in our brains where losing or experiencing loss gives us more of a powerful displeasure than winning gives us a positive pleasure. So the psychologists refer to this as loss aversion. We have a bias to try to avoid losing more perhaps than we would want to try to win in some points. And investing is a good example of that because money is a very emotional issue. And the idea of losing money, even if it's only on paper, even if it's only for a short term, seeing the value of your portfolio go down sends stress levels off the charts. And the second thing, so you pair loss aversion with the second bias here, which is overconfidence. So not only are we scared to lose, but we also suffer from overconfidence, which is like the opposite end of the problem. So what you get when you combine those two things is I really don't want to lose, and I have perhaps overconfidence, meaning I have confidence that I can time the market. I realize that for most people, it's not a good idea, but me and my big brain, I'm smarter. I know more things than other people. I'll be able to time the market successfully where other people cannot. That kind of thinking is what leads to losses in the stock market. You're trying to avoid that pain and you're deluding yourself into thinking you have this skill to be able to do it. And here's the thing about market timing and the idea of trying to avoid that loss, in the short term at all. Just go back and think about, why do stocks have a better expected return than something like bonds? Because we take on risk by investing in the stock market. The whole reason we get compensated and can build wealth through the stock market is because we're taking on risk. The difference between the returns in the stock market and something like a treasury bill that's considered risk-free is called the risk premium. So that return, the difference between the stock market and a risk-free asset, that's the risk premium. And that's why we get compensated for investing in stocks, is because we're taking on that risk. The idea that we can invest in the stock market without enduring that risk, without the risk of loss, if someone is telling you that and it sounds too good to be true, it is too good to be true. The stock market is very volatile in the short run, and we simply have to accept that if we're a long-term investor. It can be a little different if you're approaching retirement age and you want to reduce your risk. That's an asset allocation question. But in terms of just, I think the market's about to crash, so I'm going to pull out my investments now before it does, that kind of market timing, it does not work. And let's get into a little bit of research that's been done on this very topic. So Merrill Lynch, the financial services company, has actually done some research on investor performance and the possibility, the risk associated with trying to time the market. And they looked at what happens when investors try to time the market. They examined the return of a $1,000 investment in the S&P 500 from the years 1989 to 2018. And they did so under 3 scenarios. Scenario 1 is when the investor implemented a simple buy and hold strategy, meaning they bought an index fund, S&P 500 index fund in 1989, and they just held on to it until 2018. They didn't do anything, which is the smart way to go, which we'll get into. Scenario 2, the investor pulls their money out of the market thinking it's about to crash, and as a result, they miss the 10 best performing months in the S&P 500. And scenario 3 is the investor pulls their money out several times over that period, thinking the market's about to crash, and it doesn't. And as a result, they miss the 20 best performing months in the S&P 500. And the results of that study illustrate the risk of market timing. So the buy and hold investor, so if you bought that index fund in 1989 and you held on until 2018, that $1,000 turned into $17,306. That's a 1,631% return on investment. Scenario 2, where the market timer pulled out and missed the 10 best months from 1989 to 2018, meaning the 10 months that had the best return in the S&P 500 over that nearly 30-year period. And what they ended up with was $6,959. So still a 596% return, but compared to a 1,600% return, quite low. So their return was cut more than in half. And the investor who missed the 20 best months, so this would be somebody from 1989 to 2018 who's engaging in frequent market timing. So they're thinking, quite often, we're about to see a crash, and they're constantly trying to time the market. And if they miss the 20 best months of return, their $1,000 would only have turned into $3,328. A difference from $17,000 all the way down to $3,000 just by missing the 20 best months over that nearly 30-year period. And that is what the risk of market timing is. The risk is you think the market's going to go down, but in reality, it keeps going up. And quite often that is the case. In finance, that is referred to as momentum. When the stock market has been increasing, that can continue that momentum to keep increasing for longer than our human brains think it should. So what is the takeaway as an investor? Simply, if I could put it in simple terms, it's do not listen to your gut. The stock market Put it this way, nobody can predict what's going to happen in the stock market, particularly not in the short run. The only thing that we can predict about the stock market, looking back at over 100 years of data, is that over the very long run, we're talking about decades, a lifetime, the stock market will go up and to the right and provide long-term buy and hold investors with exceptional returns. In the short run, and the short run could include, years or even up to 10 years, we're guaranteed nothing, and we could see the market swing wildly down. We don't know when it will happen or how long it will take to recover, but we know if you buy the entire index and hold it for your entire working career, that's your best bet of building long-term wealth. And be wary of anybody who tells you that they know how to time the market. So I want to thank you guys for watching this video. Let me know what you think. Have you ever tried market timing? Have you thought about market timing? Let me know in the comments below. If you like this video, please leave a like, subscribe to the channel, hit that notification bell, and we will see you guys again next time.